Today, we're looking at a really sharp analysis report. Wall Street is wrong to doubt NVDA, the bull case to $4 trillion.
And it's a powerful one. It argues for a very aggressive valuation, really leaning on the new Rubin roadmap, sovereign AI, and that all-important software revenue.
It's a very strong piece of work. The core arguments are there. The numbers are laid out. So our feedback today isn't about the math itself.
No, not at all. It's more about the editorial choices, the structure. How to make that final huge $6.8 trillion target feel completely bulletproof.
Exactly. Let's make it impenetrable to high-level financial scrutiny.
Okay, so let's get right into it. The whole thing really hinges on the multiple, doesn't it?
It absolutely does. I mean, the report does an incredible job setting up the forward EPS estimate, that $6.50 to $7 range for FY27. But then
we hit the multiplier, that crucial 40x PE target.
And that, to me, feels like the structural weak point, even in a bull case this strong.
Right. They spend so much time earlier, and it's great work, dismantling that bearish idea that margins are going to collapse from 75% down to, 55?
Yeah, and they build that counterargument on Pillar C, the high-margin software business, NVDA.
I see the disconnect. When they get to the actual valuation, they just label the 40x PE as a standard for high-growth tech monopolies.
And that's where the defense just kind of collapses. That crucial 40x PE target multiple needs to be explicitly anchored to the structural defenses they already built against margin compression.
Exactly. The weakness is that you have this really sophisticated, detailed defense of the high margins in one chapter, and then the valuation chapter just reverts to this, generic justification.
The bears will pounce on that. They'll say it's a lack of conviction, that a pure hardware stock doesn't deserve 40x.
So the suggestion is to directly weave that software business analysis, Pillar C, right into the defense of the 40x PE. You have to show the direct link.
So how do we do that? Is it a rhetorical thing, or do you need to be more quantitative?
I think you need both, but rhetorically, the structural argument is just key. Give the person reading this a precise sentence they can grab onto.
Okay, like what?
Something like, you could rephrase the defense of the PE by saying, the 40x PE remains justified because the 90+% margins from NVDA software act as a structural floor.
A structural floor.
Offsetting the projected margin collapse risk in the hardware business. That phrase, structural floor, it just instantly raises the quality of the argument.
That is really powerful language. It connects the premise, which is the software revenue, directly to the conclusion, the premium valuation. I wonder, though, for an institutional audience, maybe something quantitative would be even sharper.
Why do you think so?
Well, the whole bear case is built on percentages, right? 75% collapsing to 55%. If we want to shut that down completely, you have to show the new blended margin.
That's a fair point. It would ground the premium multiple in some really hard data.
Yes. So a concrete example could be just adding a brief sensitivity analysis. Show the resulting average blended gross margin, say it's 68-70%, when you factor in that high margin NVDA revenue.
And that blended number proves why the market should keep rewarding NVIDIA with a 40x multiple. It's structurally different from a pure hardware company. It completely disarms the 55% margin fear.
Right. By showing how the software changes the fundamental cost structure, you don't have to argue if the margin holds.
You just have to argue how high that new blended margin will be. Yeah, both the structural floor narrative and the blended margin math are, I think, essential to fix this.
Okay, let's move on to the overall narrative. The structure. I really want to talk about the psychological goalposts that the report sets.
I thought that framing was excellent. The title, the executive summary, they talk about the road to $4 trillion being done and the road to $5 trillion starting now.
Yes, it establishes that immediate next psychological milestone. I mean, with the market cap where it is, $5 trillion is the logical short-term hurdle.
But here's the weakness. The final math, it just jumps. It goes straight from the current market cap to the implied $6.8 trillion target. It never actually references that $5 trillion goal again.
And that creates a little psychological break, right? A disconnect for someone who was promised that $5 trillion mark as a key part of the story.
It's a critical narrative gap. You have to treat the $5 trillion mark as the immediate catalyst. You have to show the metrics to hit it before you present the bigger long-term target.
Otherwise, that $5 trillion anchor you set up in the opening just starts to feel like, I don't know, fluff.
Yeah, I can see a skeptical analyst reading the summary, expecting the math for 5 trillion and then being let down when the analysis just skips right past it. They might even think the 5 trillion goal isn't robust enough to stand on its own.
Exactly. We need a clearer narrative arc. You have to explicitly position that $5 trillion figure as a confirmed milestone on the path to the ultimate $6.8 trillion. And it's an easy fix, but it adds so much credibility.
So an example would be, within the valuation section, you just include a short quantified step before the big goal.
Something simple, like the $5 trillion milestone. Based on the current TTM EPS, reclaiming $5 trillion only requires the market to price in early Blackwell sales, or something like that.
That immediately grounds the short-term case. It makes the long-term case feel, well, less daunting. It shows it's not one giant leap, but a logical two-step progression.
Or, here's another thought. What if you use the 5 trillion figure to actually segment the whole bull case target section?
Oh, that's a more sophisticated structural approach. How would that look?
You differentiate the short-term goal, which is supported by immediate stuff like Blackwell sales and early sovereign AI, from the long-term target, which is supported by the 2026 Rubin shock and the full, multi-year sovereign AI deployment.
I like that. You're using a psychological marker, the 5 trillion, to give the whole report a clear phase timeline. It strengthens the entire structure by showing there are multiple catalysts, not just one distant target.
It makes the whole progression feel earned.
Okay, let's talk about Pillar B, sovereign AI. This is, I think, a brilliant counter to the usual cyclical arguments you hear.
It really is, identifying $10 to $15 billion in fresh annual revenue from governments, Japan, Canada, India. It's powerful because it directly addresses that dependency on the hyperscalers.
It just fundamentally changes the conversation around NVIDIA's revenue stability. The report calls this non-cyclical, government-backed spending.
And that's the core strength of the argument, but it's also where a small vulnerability lies.
You're talking about the nuance of execution.
Exactly. The weakness is that government contracts, while they are stable in terms of funding, they're often subject to, bureaucratic slowdowns, regulatory friction,
geopolitical changes.
All of which could seriously impact the timing of when that revenue is recognized, even if the money itself is guaranteed.
Right. So presenting it as this unqualified, guaranteed fresh revenue stream, it leaves a small, very predictable opening for skeptics. An institutional investor won't doubt the money's coming, but they will absolutely challenge the timeline.
So while the sovereign AI forecast is this powerful counter-bear argument, introducing some controlled nuance about execution risks would make that 10 to 15 billion projection way more robust.
It would preempt that skepticism, but we have to be careful, right? You don't want to undermine the central bullish point. If you start highlighting risk, aren't you just validating the bearish concern?
I don't think so. The goal here is to demonstrate awareness, and that builds trust. Acknowledging a minor, temporary execution risk just makes the whole analysis seem more comprehensive. It confirms you haven't overlooked the obvious pitfalls of government spending.
So the suggestion is to briefly acknowledge those external risks.
Yeah, just reinforce how comprehensive the analysis is.
I agree. The credibility gain is worth it. So, for a concrete example, you could suggest a minor edit in Pillar B that qualifies the timeline.
Right. Something like, while non-cyclical, analysts must account for potential 6 to 9 month deployment delays common with large government-backed projects, meaning the full 15 billion run rate may not hit until late FY27.
That's perfect. It addresses the skeptic without changing the forecast's ultimate destination. Or, another way to do it, to link it back directly to the valuation model.
How so?
You could identify a specific variable that could slow things down, like, say, slow infrastructure build-out in a country like India. And then you briefly state that this execution risk is already accounted for in the conservative lower end of your EPS estimate.
Oh, that's a very strong move. It shows foresight. It shows confidence in the model's integrity. You're basically saying, even with predictable delays, our math still holds.
That's what high-conviction analysis reports do. They address the counter-arguments within their own estimates.
This has been a really great in-depth look at what is already a stellar analysis report.